Morning, welcome to One Financial Markets Morning Commentary. I'm Andrew Johnston. We're just going to go over a few things that happened yesterday and looking forward to the head today. A busy day today, but yesterday we had the Bank of England rate decision. MPC left rates on hold and the vote remains 62 in terms of hike. The UK quarterly inflation report came out and the pound fell on the Bank of England as it kept the rates on hold, as I said they would. And they had the lower CPI and GDP forecasts and basically Carney being a lot more dovish than he was previously where he was such a big hawk. So once again, no one knows what Carney's standing for here. He's changed his rhetoric from being a hawk to a dove. And there's still concerns over the growth of the economy in the UK. So here we have this lovely, as soon as Carney started chatting, and this puke where everyone who was, all that 40% out there who thought that there was going to be a hike, they all got stopped out, and then it goes down further, because there was people, traders out there, punters, you might want to call them if they're trading over an interest rate decision, who had long positions going into that, and as soon as his comments came out regarding his stance or his dovish tone, if you want to call it that way, and that there'll be no discussion of raising interest rates in larger increments than 0.25, and that there is the UK economy potentially could have more monetary policy consequences. All this rolled up into a big bowl to basically get out of the market and sell some sterling. And this is what we had here. If you look at the chart, we've had a small pullback, and look at this on an hour chart. There's your resistance, and there's your support. Look how that's traded for the last 10 hours, like that, after this moved down. So we have to look at this in a rather longer scheme of things. And if we just stick some chart on here, well, it's broken through that trend line that we appointed there, and from the consolidation zone that I pointed out previously on the days one. Let's go back to that. So yeah, we're still in this zone here where I picked it previously, but we're at the bottom range of it now, and we'll just have to take into consideration his comments. I don't think really it's going to make much difference. It's just all those people that got out there, the guys who went long going into it in terms of the interest rate decision and the fact that they were pricing in a 40% chance of a hike. This is what this is. It's nothing in terms of a daily move, 100 pips, maybe 80. At most, if you got caught out on it, obviously it extends towards the end of the day as people look to flatten positions and close up shop and go and have a glass of wine as it's Thursday. So it's going to stabilise around here for a bit, and then, as I say, it's in that trench, the higher trench will happen after the Brexit, and we'll look to consolidate in this year. It's right in support now in terms of that, so we'll see how the direction go from there. But today we do have the non-farm payrolls job number. It's looking to be survey 180, 187 prior. And this is to see how many jobs are created in the non-farm sector in the UK, in the public sector, rather than private. And it is just a complete guess. Nobody knows. If you trade it, in my book, you're insane. The volatility, the price action, the liquidity, volatility goes through the roof. Price action is, try and watch it, it will give you an epileptic fit. And liquidity, nobody wants to be making a price. You're going to need banks. There's no way that they're going to be in any size at any price and that. Nobody, the prices you see are so tight because you might see maybe 10,000 or 100,000 notional value to be done at that level. You're not going to see millions in a tight spread. Certainly not on a one-put spread. You're not going to see. So that's why spreads widen, because liquidity can only be filled on widened spreads. So we'll have to take that into note when trading today. But do not, if you want my personal advice, let the non-farm payroll number come out, let the market digest it for half an hour, and then come up with a trading strategy or plan. Do not try and trade over the figure. Do not try and predict what the figure is going to be. This estimates this morning have been from 250. Someone said on the CNBC to potentially 150. So I mean, it's just a complete guess. So like I say, just be very, very cautious about the non-farm payroll at 130 today BST. And if you want my advice, do not try and trade over it. Do not have a trade going into it. And if you want to trade after it, make sure that you place your stops respectively, because the craziness this occurs over this figure is manic. It used to be back in the many years ago. It used to be the Michigan figure that people used to get over a phone line in the office, and now everyone's talking about the non-farm payroll, and it's the biggest, and then everyone's got to follow it. People like me are fed up with it. People who have been in this game a long time. We've got no time for the non-farm payroll and what it provides in terms of market direction. It is just a complete guess, and the price action and trading around it is all a guess as well. If you're a retail trader, and even a professional trader, they have no idea. Like, you know, you could be at UBS or Goldman Sachs and have the best economists in the world, and they will not get this figure right. So if someone who has a portfolio of $2 billion and is not going to trade non-farm payroll, I'm certainly not going to trade it. But if you guys out there are looking to do it, then please place tight stops, and please be very risk aware of the capital you're using in terms of this, because deficits can occur and you can lose more than your initial capital in your account, just based on the way that this figure can cause mayhem. So for me in the front lines, have a good trading day and be really safe out there, because it is a weekend, so we don't want to have an upset before enjoying our 2 days off. Take care.